Hi, it's 1 o'clock. For those of you all logging in to join us, we're going to wait a few more minutes to let people log in, and we'll be getting started at approximately 1:03. Thank you.
Hello, everyone. This is Nia Reddick. I am your moderator for today. So welcome to UDC. I just have a few key points to mention. Please keep your mics on silent unless you are commenting or asking a question. And at the moment, we will wait for more people to join. However, we can move forward and hear about UDC and some of our valued sponsors.
I never dreamed this career was possible. I absolutely love what I do. My name is Steven, and I'm a proud graduate of the University of the District of Columbia. I received my Master's of Public Administration in 18 months, and during that process, I had 2 promotions and graduated debt-free. The professors had real-life experiences. UDC helped me change my dreams from impossible to possible.
Find your possible. Visit udc.edu/possible to learn more.
Welcome to the Marion Barry Summer Youth Employment Program.
We are grateful to UDC for the opportunity to speak with you today. I'm Christy.
And I'm Stacy. We are the proud 3rd-generation owners of Lee's Flower and Card Shop. Did you know that Lee's has been around since 1945?
That's right. We have been on historic U Street for 75 years. Our grandparents, William and Winifred Lee, established our shop when they were young adults.
Today, you are among the many DC residents, including members of our own family, who got their first work experience in this program. And we are proud to be hosts to participants each summer.
Our words of advice: take advantage of all the opportunities you are presented. Enjoy and work hard.
Okay, so right now we are up to the raffle challenge. So I just want to give you an update. The raffle challenge is only eligible for people that are in the SYEP program and the MBYCI program as well. Through these slides, you will see what raffles, what raffles are available. So one will be from the Ben's Next Door restaurant and also Lee's Flowers. Oh, I'm sorry, the Cherry Blossom Festival and Nando's restaurant. So those are the eligible prizes that are for those participants. We will move forward with the presentation of Personal Finance 101, where Professor Albert Purcell will be speaking and Professor Stephen M. Oriol will be speaking.
Great. Thanks so much, Nia, for your introduction. And welcome everybody to day 2 of our discussion around personal finance. And so yesterday, hopefully you got some valuable information around what money is, why personal finance is so important, why poverty can be so expensive, and also a little bit of information around building credit and how the road to financial success is pretty complicated and you need to take it seriously. Also, we heard from Robert F. Smith talking a little bit about how challenges to turn education and income into wealth and how much of an impact that can make over our careers. Today, our objectives are going to change slightly, where we're focused on implementing your financial life plan. This is really geared towards making personal finance and understanding it a personal process and something that will hopefully resonate with your own experience and what unique circumstances you'll bring to the process and how to get the most out of it. And so we'll be, as you're taking notes, we want you to specifically look for what are the key skills and habits of personal finance that will help you make more sense of the decisions that you have to make moving forward. And like we did yesterday, we want to structure our discussion around asking some questions, giving you an opportunity to reflect on what those questions might mean for you, and then address what actions might be most appropriate for you moving forward. Professor Pearsall, do you have anything to add up front?
Yeah, thank you, Professor Oriol. One of the things I want you all to remember what we discussed yesterday was we're going to talk to you about what we think is important as wealth building. And when we talk about what money is, we want to let you know that money is part of wealth, but money is just a component of wealth. And we're going to talk to you more about what assets are. But then we mentioned yesterday the most important asset that you have. And your most important asset is you. And so we wanted you to think about how you invest in yourself, how you strive for an education, how you can look toward coming to UDC to actually fulfill that opportunity, to actually start that process of growing and becoming a part of the economic system. So with that, I want to say this before we start, and I want to thank, first of all, Guardian Life Insurance Company, because they actually fund the personal finance initiative at the community college. And it has enabled UDC to be a very unique institution among historically Black colleges in that we require financial education in order to get a degree. So with that, Professor Oriol, let's go ahead and continue. Thank you, sir.
Absolutely. Okay, so as we mentioned yesterday, personal finance is an all-encompassing aspect of our lives. And so we want to start with the question of who actually needs or wants a financial plan? What good is this to have a plan in place? And also important to consider is that the process of planning is not something that provides an answer that is always upfront. And so when we look at the issue of planning, there's a great quote, and maybe Professor Pearsall can get it into the chat room here. But the late great Peter Drucker used to say that planning for the future is invaluable but useless. And I think what he was talking about was the idea of making the effort to go through the planning process. Through that journey is where a lot of the insights are arrived at and empower you to make better decisions moving forward. So it's a fluid process, and what we're going to go through are the 6 steps to actually building a financial plan. Now, just a word on needs and wants. The last few months have probably taught us a little something about what are needs versus what are wants and how important each of those are. I think on some level, we've begun to realize that there were some of the things that we had listed as needs, which maybe we don't need that much, and then other things that may have been wants for us, and the rationale of how much it makes sense to maybe emphasize going after some of our wants and doing things to limit what we feel we might need. So that introduces values into the process. And so think of that in the back of your mind. Are the things that are sometimes listed as what you need really important to you? Are they really what you want? Because sometimes if we have a whole stack of needs and we don't have enough room for the things that we really want, it's hard to get emotionally excited about what we're trying to do. Okay, so step 1, we're talking about determining your current financial situation. Knowing where it is that you start in a journey is pretty important. If I'm looking to travel from New York City to LA, I am going to have to one, confirm that I am where I am. If I'm going from New York to LA, I can't be tracking the same way as if I was going from Washington State to LA. Okay, so knowing where you start is one of the most important attributes, and you really have to have good information of your current financial situation today. Where are you today? And we'll talk about how to clarify that as we move along. The second step is developing goals and prioritizing your objectives. Many times we have so many goals that there's no possible way to focus on the most important ones. And number 2, if we have a goal that is not specific enough or doesn't resonate with our value system, then it's hard to really get up and focus on the energy that we're going to need to bring to that task. So we're going to talk a little bit more about how to make our goals more effective. 3, we talk about identifying alternative courses of action. So if I'm heading from New York to LA, I need to know that there are some different alternatives in terms of how to get there, right? I could fly a plane, I could drive my car, I could ride a horse, I might even want to walk, right? But knowing what alternatives exist can help us hone in on which way to go. 4th step here, analyzing and evaluating alternatives. This is a process that obviously takes time when you're looking to make decisions. How do you go about evaluating what might be a better route or might be more efficient? Clearly, a plane is going to be less time to get from New York to LA, but it's also going to be more money. And maybe that's some of the factors. So again, I'm giving you some of these analogies so that you can kind of think through and say, yeah, that makes a lot of sense. If I know I'm completing my undergraduate degree in a certain period of time, what it's going to take to get me from where I am to where I want to be, I need to be able to know what my alternatives are, and I need to have a methodology of evaluating those alternatives. Fifth step here, how to go about creating and implementing your action plan. I can tell you from experience that a lot of people get through phases 1 through 4 and they just can't get themselves to act. And so being able to implement a strategy and get a plan in motion is more important than getting the perfect plan together. And so knowing that you have a well-informed plan in place and getting it moving is more important than trying to figure out the perfect plan, okay? And number 6, being able to monitor your progress and revise your plan over time. Look, we know this. You're never gonna have the perfect whole set of metrics, and over time things are going to change. That is one guarantee in any type of planning, and you need to have a way of being able to monitor the progress that you're making over time, because one thing that's certain, you're going to need to course correct. So you may have the idea that you're going to be pursuing an engineering degree, and then halfway through your first or second semester, based on your interests and your experiences, it might be time to pivot to another area of interest. In my travel analogy, the plane that takes off from LaGuardia is going to be course correcting the whole way as they move towards getting to LA. So as a framework, being able to put a plan in place and having some metrics around how to do that more efficiently is what we're going to go through today. Professor Pearsall, do you have anything to add?
No, sir. You did an outstanding job.
Okay, excellent. So one of the things that we did yesterday as we go through this material, I want you to think of what are some questions that you might have. What are some reflections that, as you're hearing the information and formulating some inquiries, feel free to throw these comments into the chat, and so we're going to be able to respond to questions as they come up. And if you've got some insights or different areas that, hey, what about this? Feel free to include them. Okay, and we'll try to get to as many of those as we can in our time before we leave today. So
one of the things I wanted to share, Professor, is that we have to always think about our goals. Goal in planning is nothing more than looking at where you want to go and charting a pathway to where you want to be. So when you look at the SMART goals, what we want to look at where are you in life. Are you a single person? Are you married couple? Are you an older a couple with older children? Depending on where you are in life, your goals are going to change. And we want to look at our goals in terms of short term, less than 2 years, intermediate goals, which is at mid-range, 2 to 5 years, and long term. For example, many of you right now, your your short-term goal is to graduate from high school and to complete college. And some of you may even have the opportunity of doing both at the same time. And so you look beyond that. What's gonna be beyond 2 to 5 years? Well, some of you it may be graduate school. Some of you it'll be looking at your profession, at your first start in your profession. Long term, beyond 5 years, it may actually be I may want to live in Hawaii. I may want to, you may think about, is it time for me to buy a home? Or maybe, who knows, maybe you'll even be married at that point. All of these are decisions that we make, and we want to make sure that our goals are specific, that they're measurable, that they're action oriented, that they're realistic. So don't say, for example, I want to have $1 million in a year. I mean, getting $1 million in a year sounds really good. That's a wonderful goal, but is that realistic for most of us? And also, it should be time based. You got to give yourself a time horizon in order to get it. So if I say that I want to have $100,000 in my retirement account in 10 years, that's realistic for most people. And so, but you have to start that process of doing it very early. And so, retirement's important, but it's also important the steps that you take in order to get there. Professor?
Great. The only thing I would add to that is when you're in the business of setting goals, it's very important to make sure that the goals that you set out are your goals. If you're setting out to do something that is the goal of somebody else, there's no way you're going to muster the amount of energy and intensity that's required to actually follow through on that goal. And so I think one of the things that we want to make sure we do is, if we're going to pursue something of significance for us, we need to tie that goal to our purpose, right? There has to be a connection between what we do, why we're doing it, and how we feel this is going to help us get from where we are to where we want to be. There has to be some value consistency in terms of setting that goal. Jessica, if we could go to the next screen, please. Okay, so as Professor Pearsall indicated on the right side of the slide here, setting SMART goals, we're talking about specific as opposed to general goals. They really have to be honed in on something that is vivid. One of the things that I like to make sure I do when I'm describing a goal is I want to know what that goal looks like. So visually, what does that goal look like? The other way people like to process information is by how it sounds. So the goal has to look good, but the goal also has to sound good, right? So I not only want to see what the goal looks like, I want to know what the goal sounds like. And even further, how would it feel to make sure that goal was accomplished? So as a kinesthetic feeling around a particular goal, this is really critical, because if you can see the goal, you can hear what it's like, and you can relate to how that goal will make you feel, then all of those things are conspiring to make sure that goal is going to be more likely in your future. From the measurable standpoint, there has to be a way to quantify not just getting there, but how do I know that I'm moving along the way in the right direction, in a way that I can actually know, hey, am I moving forward today? A certain amount of hours that you put into reading for class, for example, or a certain amount of exposure to new ideas. One of the best advice I ever heard from a great friend of mine, Torrin Ellis, was 15 minutes a day, Steve. You spend 15 minutes a day learning about something that you don't know now is a great habit to establish, because while you're focused on things, it also gives you a little bit of an out to say, what are some other areas that I might want to pursue down the road? But getting into the habit of that 15 minutes has been a great addition, I know, for me. The attainable goal, make sure they're realistic and real to you as opposed to someone else. We already hit that piece. And then finally, this idea of having goals that are time bound is absolutely critical. If, as the professor was saying, coming up with $1 million, if I've got 50 years to come up with $1 million, yeah, I can kind of put that off a little bit. You know, there's always tomorrow. But As you know, urgency and action are very important to bring to anything that we try to do. And anytime we give ourselves a little too much space, we're likely to use it. So, the task fitting the time allotted is absolutely appropriate. Now, I've got some good news for you today, because on the left side of the screen, many of you have aspirations to become business owners at some point in the future. So congratulations. I'm going to tell you today that you have 6 employees. You've got 6 employees working for you today. And we call those 6 employees where, why, when, what, how, and who. And if you can get those 6 employees working for you today, this is probably one of the most powerful ways that you'll develop the skills and habits of entrepreneurs. And entrepreneurs are essentially creators, right? We're talking about creating a future that is important to you. So think of those questions as we go through some more of the material here. Where is it that I'm going? Where am I going? Why is this important to me? When will I make it happen? Right? And what will I do first? Prioritization. How will I do it? And who can help me along the way? If you can put these 6 employees immediately on your payroll, your results are going to be that much better for anything that you set out to accomplish. Okay, Jessica. Oh well, before we move on, Professor Pearsall, any thoughts on the screen?
No, sir. Let's move on.
Excellent. Let's move along.
What I'd like to share with you all is that when we talked about, one of the things that Professor Orion and I are strong believers in, and we're believers in wealth building. And what we want you to understand is wealth is comprised of everything you own of value. Money is just one component of that. It also includes your property. It includes your investments, anything of value. And what you want to do is you want to subtract from that any and everything you owe. These would be your debts, your credit card debts, your loans, all of that you subtract from all the things you have of value. And after you've done that subtraction, you get this number, your net worth. Your net worth is an indicator of your economic value. That is a number that we really want to reach. What our goal is to try to have as many assets, things of value that we can possibly have exceed any and everything that we owe. And that's going to indicate what that value is. And I think Professor will walk, matter of fact, Jessica, if you could play the video, and it's going to show you what a balance sheet is. A balance sheet is a financial statement we use to give you a snapshot of what your value is at a particular point in time. Okay? Remember the formula. All right? It's assets minus liabilities equals net worth. If you're a business major, you all will think about it as assets minus liabilities equal owner's equity. Okay? So it's the same basic principle. Okay?
Sheet, sometimes referred to as a net worth statement, is a financial statement that reports what an individual or a family owns and owes. 3 steps are required to prepare a personal balance sheet. To prepare a personal balance sheet, the first step is to list the assets you own. For an individual or a family, typical assets include bank accounts, investments, real estate, and personal possessions that might include automobiles, furniture, computers, and jewelry. The dollar amount for each asset listed in this section should be the actual or estimated current value of the asset. The second step is to list your liabilities. Liabilities are the amounts you owe to others. For most people, liabilities fall into 2 categories. Current liabilities are debts that must be paid within a short time, usually less than a year. For example, the amount you owe on your credit card is listed in the current liability section of your balance sheet. Long-term liabilities are debts that are not required to be paid in full until more than a year from now. A home mortgage, for example, is a long-term liability. The third step is to determine your net worth. Net worth is the difference between total assets and total liabilities. As shown in the personal balance sheet for Rose and Edgar Gomez, their net worth is $159,240. While the net worth calculation provides a measurement of your current financial condition on a specific date, the goal is to increase your net worth over time. To increase your net worth, you can increase your savings, reduce spending, increase the value of investments, and reduce the amounts you owe.
Okay, great.
Jessica? Okay, great. Thank you. Next slide, Jessica.
Actually, Jessica, before you go to the next slide, here's another thing that I want us to think about. When we think of net worth, when we think of a balance sheet, as the professor was indicating, there's always a sense of balance, right? So what you own minus what you owe equals the net worth number. Here's a thought on where you are in your life and in your career. You have far more of the value that you will create in your life ahead of you, right? There are going to be years and years of earning and experience and impact. And so understand that your greatest asset, and I know we mentioned this, but you being your greatest asset means that the majority of your balance sheet today it's in your potential, right? And so I'm going to give you another gift. I'm going to make the case that you all are already millionaires, right? Because the assets maybe that you have in the bank, cash, and a degree or two or three under your arm, right? Those are part of your future. And so this asset, if we can think of it that way, is really the potential in your future. So when we look at hard assets, soft assets, and maybe aspirational ones, these are not yet realized. By the same token, what you owe today in terms of direct dollars owed to creditors is not the same as the things that you would like to accomplish. Buy a house someday, buy a business someday, maybe fund a college education for your children or grandchildren. Think in terms of what I own, what I owe is my ultimate net worth and impact. I know that sounds a little bit nebulous, but I promise you the decisions that you make when you take into account all aspects of what you value are going to make the decisions that much better. Okay, Jessica, if we could get on to the next screen, please. Professor Pearsall, here we've got some more, a little bit more details. Maybe you could point out some of the components.
Yeah, is it possible to enlarge in the slide? Okay. All right. Yes. Okay. This is basically nothing more than a representation of a balance sheet. The first thing you'll notice is the balance sheet reflects our net worth as of a specific date in time. And so what it does is under assets, we have a category called liquid assets. Those are assets that can easily be converted to cash quickly. So it's called liquid. Liquid, like you're pouring water, it means it can quickly become cash. So your checking account, your savings account, anything that can convert to cash, your cash value of a life insurance policy. Then the next phase in this particular person's portfolio, which I would always recommend for all of us, would be real estate. It's very difficult to bypass real estate and become a millionaire. Most millionaires tend to have a decent real estate portfolio. So real estate would be a part of it. And then the next would be your personal possessions. For example, your automobile. Automobiles have value, but we consider those depreciating assets, meaning for every year you own your automobile, it's going to be a little less in value. Now, sure, if you're lucky enough to get one of those antique automobiles that, that are collectibles that people love and you see them, that's the rare case of where an old vehicle will actually grow in value. And for collectibles, that's fine. And having collectibles, that can be part of your possession, your comic book collection, your various doll collections, anything that you can exchange for money, and there's a ready audience for it, has value. The furniture in your home, all of these things are value. And remember, these are depreciating assets. Generally, they're going to be a little less in value. Also, your home entertainment system, your computers. For example, a computer bought today is clearly going to be less than in a year from now. Now, jewelry. Jewelry is very interesting. Jewelry is generally a depreciating asset, except if you have it appraised. And if you have it formally appraised, it will reflect that particular value. And the other area of assets are investments, which a professor will talk to you about your retirement account. Most people, when you have an employer, you invest in your retirement account, your mutual funds. These are important assets that one would have. So when you look at your total assets for this couple here, and they add everything together, they have $259,040. So what you have to think about is that's just your assets. Well, now we have to look at what we owe. Could you scroll down a little further? Okay, if you now you have liability, that's right there. Liability are your debts, things that you owe. So when we look at our current liabilities are liabilities generally within a relatively short period of time. These are things that are relative, that are due within 6 months to a year, and in a shorter period of time. Medical bills are certainly your current liabilities. Any credit card balance can generally should be able to be paid off in a relatively short period of time. Balance on an auto loan. Now, auto loans can take you a little longer, 3 to 5 years. We'd like to not have auto loans going beyond 3 years, but sometimes that's not practical. And so those will be your current liabilities. Your long-term liabilities are those liabilities you're going to pay for on a long-term basis. For example, your mortgage. People will pay on a mortgage for over 30 years or more. Sometimes if you are able to finesse it, you can pay it a little bit less. Home improvement loans can take you a while to pay off. Student loan can take many years to pay off. These are those long-term liabilities. So when you look at your total liabilities, current and long-term, for this particular couple, $99,800. So in order to determine the net worth for this couple, you would subtract the total assets, $259,040, from you would subtract the current liabilities, or I'm sorry, the total liabilities, which would be $99,800, from $259,040, and you will come up with a net worth of $159,240. Okay, that's the person's net worth. That is generally what they have of value, because that means that once you have subtracted out all of what they owe, this is exactly what they possess. And so net worth is a very important measurement of where you are financially. Professor?
Great. Thanks very much, Professor Pearsall. We could go to the next slide, Jessica. Great. So the same way that we notice or look at the balance sheet as a snapshot in time, the net worth statement really tells us a story of where have we been and where are we today. So one of the questions I might ask a client if I was sitting down and speaking with them and looking at their balance sheet, I will say there's a particular amount in a particular kind of account. I might ask them, tell me how that got there. Does that particular account have a specific purpose in your overall plan? And typically, these different accounts are going to have different purposes for what they're used. A short-term savings account might be there for liquidity. It might be there for emergencies and or opportunities, because you never know when things might come up as opportunities. And if you have the capacity to pursue that opportunity, then that's going to differentiate you in the marketplace. And so as you look at those different accounts, you have to be able to think through, what is the purpose behind this? I mentioned yesterday, hopefully you caught this, but many times for short-term credit, we use short-term credit out of a desire for convenience. I can swipe and immediately I can get whatever I need to buy, but there has to be a plan in place to pay that off right away. Okay, so we use credit for convenience. Similarly, when we have a longer term liability that we typically structure through a loan, we do that for leverage. So for most people, they can't afford to pay cash for a home, right? So they have a loan that's structured to pay off that mortgage over time. Same thing with a car. And as Professor Pearsall was indicating, it's important to understand whether we have an asset that's there and that's going to depreciate over time or lose value over time versus an asset that we purchase with the idea that that asset is going to grow in value. And so the characteristics of how assets and liabilities sit on our balance sheet is critical to point out. Okay, now on to cash flow. The same way that the balance sheet tells us what happened or what has happened and where we are in terms of a point in time, what cash flow is a much more fluid document. This is where we're looking at what is it that's actually flowing into our situation in terms of income. So you see there in the green box, total cash received during a specific time period. So whether that's weekly, monthly, or however long it takes for income to come in versus the outflows over a period of time. And that those are things like spending in all different types of categories. Now, over time, what happens if our income is greater than our expenses or outflow? Well, that creates a surplus. Similarly, if we have less cash coming in than the amount of dollars going out, that's going to create a deficit. Now, over time, it makes sense that a deficit each year is going to lead to what? It's going to lead to more and more debt. And so the reason that we have to be so vigilant about what's happening to our cash flow is it may not feel like what's going on is what's going on in the very short term. And then one day you wake up and you're like, oh my goodness, I've dug myself into a hole here. And so making sure that you have a good understanding of the flows, both in and out, is an important consideration. We might get into a little bit later some details around how debt changes the picture over time, but also if we can differentiate between debts that are designed to help us enhance our ability to earn, that's a different type of debt than one that was just used for, hey, I just felt like spending money on X. And so I want to differentiate there, because when we think of the money that we might spend on education, the money that we spend has to be geared towards, how does this additional skill set going to allow me to earn more in the future? Okay, so we've got another video for you, and this is going to talk to us a little bit about what we call budget variance. So what happens when there is a differential between what comes in and what goes out, or vice versa.
Financial planners recommend a budget in order to track how you spend your income. The goals of budgeting include helping you live within your income, spending your money wisely, reaching your financial goals, preparing for financial emergencies, and developing wise financial management habits. Because of changes in income and expenses, it's not uncommon for people to have a budget variance. A budget variance is the difference between the amount budgeted and the actual amount received or spent. For example, if a family budgets $400 a month for food and spends $372, there would be a surplus of $28. A surplus is the amount by which actual spending is less than planned spending. In this example, the $28 surplus amount can be used to increase savings or spending. A deficit is the amount by which actual spending exceeds planned spending. In the second example, a family budgets $400 a month for food, but spends $450. In this situation, there is a deficit of $50. Spending more than planned may be justified by reducing spending on other items in your budget or reducing the amount you save. Budgeting is an ongoing process, and there should be monthly evaluations to make sure income and expenses are realistic and to make sure there are no significant budget variances from one month to the next. If budget variances do occur on a regular basis, it may be necessary to revise your budget and make changes to eliminate variances. Also, it may be necessary to add new items to your budget as your lifestyle changes. For example, if both you and your spouse join a health club, it may be necessary to include the membership costs in the expenses section of your budget. Above all, keep in mind that the goal of budgeting is to make sure that you live within your income, spend your money wisely, and attain your financial goals.
Next slide, please. Okay, yes, what we have here is we actually have a cash flow statement. Now, cash flow statement is an important statement because, again, as Professor was sharing, what we want to do is we want to control and look at what we have coming in and what we have going out. And you want to see where you are, and we're gonna morph from this toward the actual budget. So in this particular situation, we've got Kim Walker, and this is her cash flow statement for the month. So cash flow statements usually cover a period of time. It can generally be a month. Month is good, but it can also be 3 months. It could be a period of 4 months, 5 months, 6 months. And what you want to do is you want to look at your gross salary. Well, gross salary is okay, but really the key is your net. So what you want to do is you want to look at your gross and look at all of the different things that are taken out, those deductions, your taxes. And remember, these are things that in some instances you can't really manipulate too much. You can perhaps with your tax situation, but you always want to make sure you're having enough taken out for your taxes that you don't end up having to pay the Internal Revenue Service at the end of the year. So you be very careful. You got to pay state income tax, same thing, and you've got to pay your Social Security deduction. So and so you're looking at all of this income, interest on your savings. Now, nowadays, it would be nice if you could, get $34 interest in your savings. Nowadays, not much money we're making off of our savings in the bank, but that's let's be positive there, because there's other things that, Professor Oriole will share with you that you can kind of do to kind of, deal with that. And earnings on investments. Yes, it's realistic. You could, during a month, you could bring in $62 and maybe even more off of your investments. That's very realistic. And so if you go further down, scroll down. Yeah. Okay. Yes. If you could scroll down. Now remember, we talked about money coming in, our inflow. Then we have to look at money going out. There are two different expenses that are very important. They're your fixed expenses and your variable expenses. Fixed expenses are the amounts that do not change. That's why they're called fixed. It doesn't mean that they're not expenses you can analyze to find out whether or not you need them. For example, your cable bill may be a fixed expense, but it may be one that you can sit back and say, you know what, do I really need cable? And I will tell you, as somebody who's greatly reduced my cable expense, when I thought that I could not live without cable, I found out, folks, there is life after cable. And so you can actually save a substantial amount of money from really looking at that. There's a variety of things. So loan payments are payments that are fixed. Your rent, uh, sometimes some utilities are standard, but generally utilities are variable. Life insurance is the same, and your insurance for your apartment or your mortgage. In this case, this person has an apartment. So what this person has is their fixed expenses are not going to change every month. It's $1,669. Now, this is where I begin to salivate as a financial planner, helping my students. When I see variable expenses, I get real excited. You know when you're like a shark in the water and and there's a little blood in the water, you go at it. Well, I look at variable expenses as that area that I want to attack first. And the first thing that I find with all of my students is, do they eat at home or do they eat away? Are they eating, filet mignon, or are they eating hamburgers? You know, and what you have to do is remember, all of our choices it's a choice based on our values, but it should be based on what you can afford. So what I've had so many students who will talk about, we did an analysis. Students that were telling me that they went to Starbucks every day, prior to the coronavirus. Roughly, students can save up from $1,200 to $1,500 a year simply not going to Starbucks. So when you look at the money that you spend away from home, that's a big expense that for many people could be reduced. Clothing expense. Do you have to buy clothing every month? Now, I know that some of you, you want to look good, and you're telling me that in order to look really good, you got to buy, but do you really? Do you really? And the truth is, I've even said to students, we've done this as an experiment. I'll say, go to a thrift store and buy an item. Just buy a pair of jeans or something from a thrift store. We usually pick a high-end thrift store, somewhere in Montgomery County or somewhere. And I'll ask them to wear it. And I'll ask for people in the class to determine, can you look at anyone in the class and determine who's wearing a thrift store item? Folks, nobody can tell if the items that someone's wearing are thrift store items. And ultimately, we sometimes have a sense of, we think that this is what people are perceiving about us. In reality, they're not. So a lot of these items are, for example, telephone. We certainly need our cell phones. Cell phones are ubiquitous. Electricity can be controlled. Dry cleaning can be controlled. All of these expenses, medical expenses are kind of tough because once, that's something that we should plan for, but often when you're very young, you don't think about it. When you become my age, that's all you think about is how you control those medical expenses. So recreational entertainment is something you need to control. You need to find ways of, can I enjoy life and have fun without having to spend a lot of money? And also, you know, gifts and donations. Now, many people love tithing to the church. That's wonderful. Giving gifts is fine. But what I ask you to do is consider, when you're tithing, can you afford your tithing? You know, you definitely need to give. You definitely need to do what you can, but always try to be realistic with your expenses. And so, as we go further down, what we do is we look at our inflows and we look at our outflows. And remember, if you spend more than you take in, you have what? You have a deficit. If you spend less than of the money that you take in, you get a surplus. It's just that simple. You want to make sure that you're, and as professor starts talking to you more and we move into budgeting, this particular tool, this cash flow statement, kind of gives us an idea of where we are. Because here's what happens. In this case, this person has a surplus of $448. Yeah, woohoo! This is great, right? So now this is what this wonderful person can do. This person can now allocate $168 toward emergency fund savings. Remember, pay yourself, right? Savings for short-term financial goals. We put $80 there. But then savings and investing for long-term financial security, $200. This is why what I often do, I will sometimes ask students to create a separate account for themselves called the Pay Me Fund. So that will actually come out of, it'll actually go further. It'll be an expense, but then you want to save even further after you go through your allocation of your surplus. You know, remember, if you have a deficit, you have nothing to allocate. Deficit means that, you know, you are overspending. You're spending more than what you have available. That's not a good thing. Okay, Professor?
Okay, great. Jessica, if we could go to the next screen, I believe that's our budget screen.
Yeah, very important.
So one of the components and the biggest challenges for a lot of young people is how to manage expenses with a limited income, right? There's a lot of time that you spend in school, and so maybe there's less time to go out in the marketplace and earn some and earn money. But in context, I'm going to give you a couple of pointers on that. But I also want you to think of this statement. One reason that many people don't get what they want is that they give up what they want most for what they want at the moment. Okay? If you go about giving up what you want most for what you want at the moment, it's very difficult to get to where you want to be, because here's the reality of the situation. Everything that you look at on the television, on the internet, from other people, things that you see, we're constantly bombarded with buy this, buy that. Maybe it's save this, save that. Okay, saving money on something that I don't need or want in the first place is nuts, right? But if you think about the amount of money that's spent on advertising, totally focused on you, it's overwhelming. Okay, and so one of the aspects of using a budget as a form of empowerment for yourself is it gets you to draw a line in the sand and say, you know what, I'm going to be able to prioritize and say what is important to me, what is not important to me. And if we go through the exercise of creating that budget, then at least it gives us the opportunity to have thought ahead about, is this really important? Is it not important? because I can guarantee you in those moments, you are going to be tested. You're going to drive by something. Oh, I would love to have that. Or you see something or smell something. It's coming at you, right? So this is one way to kind of inoculate yourself. So one of the things I'm going to recommend you do, it's really 3 steps. I call it budget, track, and hack. And the idea is budget, where you have some idea or what are the categories that I can set out ahead and make this budget real to me. The second piece, track, you need to have a system that says, how much do I have to spend in different different areas, right? And that gives me some guidelines. There are tools out there and ways to at least keep score with what's going out. Because one of the things that happens, and the Professor Pearsall alluded to this yesterday, whether you're making $30,000 a year, $300,000 or $3 million, if you don't have a means of understanding what's coming in and what's going out, I can guarantee you that the effects are the same. The scale is different, but the effects are the same. So have a system in place to be able to track what comes in and out. And then the last piece is what I call the hack. And this is something that is really personalized to different individuals. Some people say, you know what, I need to figure out a way to create some barriers for myself. If I can't see it, I'm not going to want it. I'm not going to go put myself in a situation where there's too much temptation. So there are all types of ways to create some little hacks, or I call them sometimes scaffolding. Give me some help. Give me a little bit of ways to insulate myself from what I know are going to be areas of temptation for myself. Do I really need this? Does this make me happy? Is there something that I maybe have to trade instead of paying money for it? Can I offer something in return? These are all ways to think about the resources that you have available to you. If I make this purchase today, or if I can wait a little bit, can I maybe get it for less, right? So just the differential between buying something new versus buying it used. Nobody's going to know whether the car is a year old, 2 years old, or 5 years old, right? But as soon as you drive that new car off the lot, 30% loss in value, poof, like that. So think about these things as ways to manage what happens when you decide to spend money. Because again, you're on the menu, if you will, by all the advertisers that are out there bombarding you every single day, every minute of the day with hear this, buy this. Okay. The other thing I wanted to address is this idea of a limited income. I've always been a huge fan of figuring out ways to both increase and multiply the income opportunities in your life. I mentioned something before about having 15 minutes a day to read up on something that is new to you as a great habit. The other thing I would implore you to do is get into the habit of what I call the hard easy. And what the hard easy is means doing the hard thing first, then allows you a little bit more flexibility to do easy things later. And getting into that mindset toughens you up a little bit, right? And it helps with managing your energy. Some people, their energy level is highest in the beginning of the day. That's when you should tackle hard things. Other people, it might happen at a different time, but try to track and do things that are gonna that allow you to have the best chance of accomplishing, again, what's important to you, not what's important to somebody else, but thinking through what's more important for you. The other piece is if you can focus on creating more value for others versus what can you do for me, over time, that orientation is going to pay all kinds of dividends, because ultimately what the economy reflects is our values. Right now, this COVID situation has a lot of us exploring what is it that's really important. What is really important to me, my family, my community, our larger community as well. How important are things like health, right? And I can promise you that there are both challenges, which are real, but there are also opportunities to create values with the knowledge and skills that you're able to acquire. Okay, Professor Pearsall, I've been talking a while. Do you have any thoughts?
Yeah. I think the budget is the key. One of the challenges that I think many people don't understand is that the budget, which is similar in many ways to the cash flow statement, except what you've done is you're planning. You're going to say, you know what? I only bring in $5,000 a month. And out of this $5,000, I have to pay for everything that I live on. And that's what you have to do when you get old and gray like me. You live on this one income. And so what I have to do is I have to pay for everything out of it. But what I do is I plan my money. I account for every single penny. And so what happens here is that becomes my planned amount. Then I move to the next category. What I do is I go through the process of life and spending my money. And I might say, well, I'm planning on spending $100 this month. But it's the summertime. And I come from a family that loves crabs. And I decide, you know what? I want to get and put in with some family members for a bushel of crabs. So I may go $25 beyond the $100 I planned for the food. Well, that extra $25 has to come from somewhere. Because remember, I only have a certain amount of money. Now, I have a couple of options. I could take on a gig, which I think, I always encourage my business students always have a gig. That's a side hustle that's so important, whether it's a variety of things, whether you're selling a mask, a sanitizer you make, or whatever, you've got something going on. So that money has to be accounted for. But what you're doing is you're listing everything that you spend. And at the end of that month, there's a difference. You either in each category, did you spend exactly what that category said, or did you spend more, or did you spend less? Remember, the goal is to spend less in a category. But if you do spend more in a category, that's okay. It's just that you got to account for that in a different category. So that means if I'm going to spend an extra $25 on crabs, I'm going to probably maybe not spend as much on personal and health care. Maybe I'm going to not go to the movie theater. Well, right now, the movie theater, that's probably not a good idea anyway, right? So that money can obviously be reallocated. But you always want to think about what happens at the end. And at the end, as we go further down, we have this variance. And the variance, a variance means is the difference. Could we scroll down a little further? Yes, what we want to do is we want to look at what the total variances are, and we want to come to this area here. And what it basically says is this person spent $17 less than what they needed to spend, which is a good thing. You always want to spend less. So the question is, do you want, because anything that's a positive means you've overspent in that category. So the goal is to underspend, to live within your means. So using these tools for budgeting, it's really a nice practical approach. Now, there are apps out there that will allow you to do it. But let me tell you what the problem I have is sometimes with apps. Apps will do it for you automatically, but it's passive. So you're not investing in what you're actually doing. You're just going with the calculating the app, and sort of the app is driving your decision making rather than you driving it. I'm not saying don't use the convenience of an app, but I'm saying be intentional about how you use apps so that you understand exactly what it is you're spending and how you're spending the money. Because right now we're talking about money, but and how we're going to spend. But it all boils down to choices. Do you have, for example, transportation? Now that many of us are staying at home and working, and school will likely be remote or online, we're saving that transportation cost, right? Now, many of you, many of my students, uh, they would Uber and Lyft every day. Every day they're Uber and Lyfting. So let's say you spend $50 a month on Uber and Lyft. What are you going to do with that $50? Have you already just committed, figured, okay, I got an extra $50, so I'm going to go buy a new jacket? And I'm not saying don't buy the jacket, but what I'm saying is think about your purchase, because I would hate for you to have regrets, because maybe one day you're going to need that extra money to maybe put that extra application into that graduate program you want to be part of, or you need that extra money for a down payment on an automobile that's a great buy for you. But you know what? You can't get it because you know what you did? You spent all of your money. You didn't set any money aside. So again, budgeting is about choices, and and that's so critical. Okay, Professor.
Great, thank you, sir. So let's, Jessica, if we can move to the next slide. Okay, we're gonna hit you with another Maya Angelou quote here. So, do the best you can until you know better, and then when you know better, do better. Just so true, just so direct, and very simply elegant. So what we've been talking about essentially are ways to empower yourself so that you have more choices to make. If you can budget and allocate based on what's most important to you and avoid some of the things that are not, then that is going to give you much more control of your situation and allow you to put yourself in a position to take advantage of other things as they become available. Nia, I think we're gonna move to the next raffle question, and I believe we have some questions from the audience, and we'll be happy to take those.
My mic was off. So absolutely. Okay. So well, I'm trying to look for some questions right now, but I do have a question that might be pretty common for some people that, might have credit cards. So one question that might be pretty common is it possible to reach the 800 club? So having a perfect credit score at 800, right? And how would somebody attain that? And is it even possible for someone to get when they, within the first 3 years, if they do open a credit card and want to build their credit?
You want to, Professor? How do you? Basically, yes, anything is possible. Yes, you can do it. However, credit score is comprised of a couple of factors. One, you have to pay your bills on time, all the time. You can't be late. Also, your credit score is developed based on how long have you been participating in the credit system. Have you? And so the longer you've been involved, and the longer you've been paying your bill on time, you're going to get those points. Also, it looks at a mixture of credit and debt that you would have. So having all of your debt as credit cards, probably it becomes a little bit more of a challenge to get that 18. They like to see where you've got a bank loan, personal. So you have a mixture of different forms of credit that you actually pay consistently. So when you consider all of these different factors, I mean, those are a lot of the primary different factors: the mix, the time you've had the credit, the quality of credit, but most importantly, do you pay your bills on time? Credit basically, and here's what I've had to share students. We'll have an exercise where I'll ask, okay, your mother comes to you and says, I need you to co-sign on this loan for me. And the question I ask students is, what will you do? I have a lot of students, and we have a lot of debate because students say, that's my mother, she gave birth to me. I said, no, you don't co-sign for anybody. And they'll almost get ready to want to fight me. Well, that's my mother. I said, listen, if your mother, who is at least 15 years older than you, requires you to sign for her, it means, and I said, please don't hit me, it means that her credit character is flawed. It doesn't mean her character is flawed. She's a wonderful person. She takes care of little cats. I mean, wonderful. But in our economic system, your credit score is an indicator of how trustworthy you are. So you have to do all of those things. Make sure you pay your card on time, or your debt on time. Make sure you have employment. Make sure you commit all the societal things that we're supposed to do. Once you do that and you do it consistently, 800 scores are possible. But the other factor you have to consider is there's a lot of systemic bias in the way credit is kind of accumulated. And often the lenders will kind of know who you are without you giving, I mean, they kind of know. And so sometimes sometimes in minority areas, the credit might not necessarily, your score might not really reflect how truly trustworthy you are. You might be hovering around, say maybe 750, between 750 and 800, but maybe you realistically could probably be a little higher. But those are problems. The other thing you don't do is you don't default on anything. Student loans you have to pay. Many of our students get in big trouble when they allow their student loans to go. And that's why I say, go to UDC. You can afford it. Get your degree. Okay, get your scholarships. Go and get grants. There's plenty of money out there. And so what bothers me is I'll have a student from the District of Columbia who will end up going to another HBCU outside of the city. I don't want to name a HBCU because I love HBCUs. And all of a sudden I see them in my class and I say, introduce yourself. Oh, well, I went to North Korea, whatever. And I didn't do so good in that year. And I'm back here, but I got $30,000 in debt for a year of college. That's a problem. So what I think we have to do is we have to be intentional. We have to take advantage of our best resources, and UDC is the best resource. And I'm sorry to be so long-winded, Professor. You want to add?
Look, the only thing I would add, Nia, is the idea of a perfect credit score. Don't let perfect be the enemy of the excellent, right? I'd much rather have a 750 score, and I have 2 or 3 businesses that I've been able to get started, and I'm more active. I know several people who have 800 credit scores. A couple of them are very cool. The other one is boring. So, that's just my feeling on it. But do you have any other questions?
So I guess one other question would be, how early should a family or a person start learning about budgeting and personal finance? Is elementary too early, or should they start in middle school, high school? How early should a person start to become acquainted and build those necessary skills?
You should start at home when you're 1 year old. I learned about budgeting at home because my father was very frugal and I became frugal. You learn about savings. I was saving. I was in high school. I was going to Balut Senior High, and I had $1,000 in my bank account. People didn't know that, but that was because I was required to save and required to work. So you have to teach money skills. What happens a lot of times in our communities, communities of color, we don't talk money. And we don't talk about saving, and we don't talk about it. And also, I didn't learn to start participating in equities and stocks until I became I became an adult. That I lost a lot of time. If you are able to learn that young and start investing in stocks and bonds early, uh, then by the time you're my age, you're not even thinking about, you're all set. You can just do whatever you want to do. So it's never too early, Professor.
I would just add, Nia, that our financial decisions reflect our values. So the way that you treat your time, the way that you treat other people's times, is a function of how much you value them, how much you value yourself. So I think early on with kids, there are some wonderful resources out there that will teach kids that are 3, 4, 5 years old. Even yesterday, we played this video with the story bots talking about what money is. The earlier that you have a sense of what those values represent, the better off you will be. Another recommendation that I've heard is to get kids to follow some of the things that they love. It would make more sense to gift a child a share of Disney stock, right? Than maybe just the cash, and then they could follow, oh, what's happening with Disney stock. So it gets them participating into the broader economy and paying attention to what that means. I'm not saying specifically around the stock market per se, but understanding that they are part of something larger than themselves. And so it's individual behaviors and understanding that they're a part of the larger economy. So that's a great question.
Right, and Nia, if I can also add, we want to encourage our students to be entrepreneurs. One of the problems is the African American community is a tremendous consumer market, but we're not a producer market. And I think that we've got to change the paradigm. And so by investing, by participating, by being entrepreneurial, by taking risk out there in business, we actually add value, not only to ourselves, but to our community. That's the things that we need to start trying to do. So it's never too early. I mean, I learn every day. I'm learning about this, even though I've been teaching this for years. There's always something I learn. Professor Ori and I go through all kinds of interesting debates about different things that we financial planners don't always agree, okay? But I respect him and admire his perspective, and I grow from that. And so that's a process that we go through when we're actually dealing with money, learning how to deal with money, learning how to get our students empowered. And that's why I think personal finance is, to me, one of the most important classes that a student can take.
Well, thank you so much for your responses. I do think it's very helpful, and hopefully your response will be used for other people for their future, and also for younger children to grow up and have those skills, like you said, to be producers and leaders in their communities. Okay, so next we will go to our message from our sponsor, and Jessica will pull that up. Okay. All right, so we will be reviewing our raffles now at the moment. So the first one I will restate again. So what is the name of UDC's strategic plan? Hint, it is listed in the About section of the UDC website. Please send your answers to virtualcollege@udc.edu. Once again, the prize is a chicken dinner package from Nando's Peri Peri or a baseball cap from the National Cherry Blossom Festival. Only SYEP and MBYLI participants are eligible to win. Okay, so the second raffle is, where is UDC's farm located? And yes, they do have a farm. Once again, send your answers to that email listed below. The first person to respond will get a $25 gift card to Ben's Next Door or Lee's Flower and Card Shop. Once again, the only participants that are eligible are the ones that participate in SYEP and MBYLI. So once again, thank you so much, Professor Oriole and Professor Purcell. It was a very informative personal finance presentation. And I do think, that these type of discussions need to happen often, especially in schools. This should be just a class that's required, not an elective, right? So I do think that these kind of discussions are very important for our next generation and even for us as adults to constantly remind ourselves. So thank you so much. And I don't know if anybody else has any more questions or if you have any last comments. All right.
No, it's an honor to be part of this. Thank you for the invite.
Absolutely. All right. Thank you so much and have a wonderful day. And thank you everyone else for joining in.
Thanks, everybody.